So let's talk sectors, dividends, and Buffett's take on diversification. But before we jump in, we're in our new digs.
I love it.
I'm
We're
so
here.
excited.
Yeah.
So we had a
This is
little
great.
stint in my basement.
Yep.
If you're wondering why everything was so industrial and wood laid in all over the walls, it's because we were
Under construction.
We were in between offices, and now I wouldn't say it's finished the studio, but we're up and running to record our first here. I'm kind of excited about this because when we talk about diversification, it almost has like an undertone of confusion almost, because depending on who you talk to, it almost means something completely different, right?
Oh, it can be all over the board. Like you talk to an advisor, it means one thing. You talk to I don't mean to sound but you talk to the normal investor, and it typically is like, oh, I've got to be in international stocks, got to be in bonds, got to have some in cash, and then some in the U.S. And it's like these 4 pillars of how you diversify.
And then if you talk to like an asset manager, depending on what they're actually trying to accomplish, diversification could mean something completely different, where it could be like sub-diversification within an index.
Yes.
So like, well, diversification to me means, XYZ of an entire industry.
Right.
And that industry could be like the NASDAQ. So we're talking tech.
Yep.
So they're like looking within tech to diversify, if at all, what the tech is. And then you look at like the QQQ, there's zero diversification.
Right.
It's the 100 largest tech companies.
Yep.
You look at the S&P, it's the 500 largest. There's zero diversification, yet that is the gold standard of like how you measure growth. In like, so you have a topic that's so important, or at least is told to us that is so important, and yet everything that we measure against it flies in the face of diversification, which is super confusing.
And I guess some people would argue like the 500 biggest companies, there is some diversification.
But it's not purposeful.
Like the only metric in that is how large is your market cap, and you get in, right?
And the 7, they call the Magnificent 7, they're all kind of in one area, all tech driven. So the largest companies in America right now are really tech.
Yep.
Back in the 50s, it would have been more industrial.
Right.
Now it's switched. I don't know if it'll ever go back industrial. It'll probably always be tech moving forward.
At least for the next couple generations, right?
For a long time.
Yeah.
I'll probably be long gone, speaking a lot slower or something, by the time we're not talking about tech anymore.
Yeah.
In the stock market. But the reality is diversification is a very tough topic to wrangle, because it has this weight, but it doesn't have this weight. So let's talk about Warren Buffett first.
Yeah, it's one of my, and we're paraphrasing here. It's a much longer kind of monologue that he had, but his quote essentially is saying diversification is for those who don't know what they're doing.
Mm-hmm.
And what he's really getting at there is like, if you understand the market, if you're trying and you're really doing your homework, diversification's really less of a thing that you should be as worried about.
Yeah, and I love how Warren Buffett will throw out some amazing quotes. He's got some awesome ones, but this one really resonates because he's like, hey, in his awesome way, he's like, don't talk to me about diversification. Like, I know what I'm doing.
That's right.
He's like, but diversification's important because not everybody knows what they're doing.
That's right.
So, and this is a good point. Like, if you're thinking about, or if you're managing your own portfolio, it's really important to at least understand the concepts of diversification, but there's also dangers to diversification. Right. So let's talk about that. Like, is there such a thing as over diversification?
I would argue yes, because then you get to this point, like if you're really over diversified, like you asked, you can get to a point where you're completely diluted of any positive return, all because you're scared of any negative return. And so the goods don't really affect you because you're so thin, or you have so little invested in something that can grow because you're worried about the opportunity or what may happen in it reducing in your value as well. So you look around and you may have, 200 stocks that you've invested in.
Mm-hmm.
Pretty tough to get positive return or really capitalize on any one position moving.
And you look at Warren Buffett's portfolio, his own personal portfolio, not Berkshire Hathaway, and you'll notice that he's got, a handful of dividend-paying stocks. That's all he has.
Yep.
He doesn't really own a whole lot of stocks that don't pay, if any, that don't pay a dividend. And we make no bones about it. Like, we're dividend guys here. Like we love
right.
it. So when you're talking about diversification, you could also look at diversified portfolio from the standpoint of, well, if you just have dividend stocks in your portfolio, can you be diversified? Yeah, absolutely. So you
there's
can be.
There's over like 3,000 companies that pay a dividend.
Yeah, there's a lot. There's a lot.
Yeah, like, and that's just pay. Like, there's different
Yeah.
metrics. Yeah.
So, but the reality is, you can hurt yourself if you're thinking, well, a dividend stock is just one of many types of diversified investments, and I don't just need dividends. I need alternatives, which are super dangerous. I've had a lot of experience over the years with alternative investments. Not all of them are bad. I've had a lot of bad experiences, and I can tell you, if they're high payers, they bear whatever types of risk, and you're like, well, I need alternatives in my portfolio because they're different than dividend stocks. True statement.
Sure.
They are different. Do you need them? I would argue probably against that.
Yep.
And then you could say, well, I need treasuries because those are different. Well, I need bonds because those are different. Now we have 4 very vastly different investments in our diversified portfolio. Are you going to be better off than a full portfolio of treasuries, than a full portfolio of bonds, than a full portfolio of dividends? I would tell you long term, which one's going to do better.
Right.
Historically, like we've got 100 years of data, and there's a big reason why we're such big proponents of dividends, because they outperform in the long run just about every other type of investment out there, with small exceptions in shorter periods of time.
Yeah.
So
do you think the reason why all the marketing that goes to the general investor, like the do it yourself that you see on TV and stuff like that, it's always be diversified. Do you think that's because we have this tendency to look so short term? Because you just mentioned in the long term, over time, we can look at it and see, because we've done all this analysis, we can see what always wins or what mostly wins in the stock market. But do you think, I don't know, it just feels like so often they're talking about got to be diversified because what might happen this year? Like they look in such quarter by quarter, year by year metrics. So it's almost hedging this bet because this might be the year that the stock market has its correction. So how are you going to mitigate that with going into a different sector?
My honest answer?
Yeah.
It's because they want you to invest with them.
Okay.
Like it's almost fear mongering, where, the average investor shouldn't do it by themselves, because you don't, Warren Buffett's quote, like, diversify if you don't know what you're doing.
Yep.
But if you know what you're doing, then you have a different set of rules to play by. Well, everybody's got the same rules to play by. You're trying to accomplish your goal. What is your goal of investing? That should drive your diversification outcome. There's a whole lot in that. But the reality is, when you see commercials on TV, when you see whatever, it's driving you to their front door. Diversification is a wacko term in finance, because the average person doesn't really understand it. And even asset managers, they don't even take it into consideration. It's a subset, it's an afterthought of what they're trying to accomplish. So if we're trying to accomplish like a 6% rate of return, or a 9% rate of return, or whatever the goal is, or a certain amount of dollar amount of income on a monthly basis, well, when you're designing it, the first and foremost is like, how do I accomplish what I'm looking for? And then after you're doing that, is there possible that we can add in some layer of diversification? But you don't go, hey, I got to diversify first and let's just hope it works out.
Yeah.
No portfolio manager worth their weight in anything would do it that way.
Yeah.
Like it doesn't magically work out where like, okay, I'm going to do 15% here, 20% here, 7% here, 3% here, and actually accomplish something.
No, it's like, let me go build the best portfolio I can for the goal
Period.
it needs, and then we'll look back.
Period.
Okay. Yeah.
Like it doesn't work that other. And then if you're going straight to the source, like stocks, like at the end of the day, you got stocks.
Yep.
Like every fund, every ETF, every index, like it's stocks. Like they overcomplicate, they slice it a million different ways, and they wrap it in all these different shells, and they're stocks.
Right.
So when we're putting together a stock portfolio, cutting everybody else out, we have certain objectives that we're trying to accomplish, and we want to mitigate risk and volatility. We want to accomplish what we're setting out to do. we take this into consideration, but we don't put boundaries around it.
Yeah.
We're not like, we can't have more than X% of this or X% of that. And I hope you hear what we're actually trying to communicate here. Like, diversification is important, but it's not sitting in the front seats.
Right. Doesn't need to be the lead based on how you feel.
No. Yeah. That's a whole nother thing.
Right.
So let's talk about that.
You have a little story there that I think you could share.
So this topic came up years ago, 2 years ago, and I was with a very high profile compliance director at a major firm, like big firm. We were getting ice cream, and we were with a bunch of people, and we had a very in-depth, hardcore conversation specifically about risk, profiling, diversification. And I was trying to ask them very thought-provoking questions because I was really curious how we would answer. Because we live in a glass house.
Mm-hmm.
Like, everything that we do is on display. When you're talking to a broker, or somebody at a big wirehouse, they get to hide behind so many different curtains. And you're like, well, which hat are you wearing today?
That's right.
Like, is this in my best interest or yours? So I was, and he's a good friend. So we're having a very transparent conversation. I said, let me ask you this question. If one of your advisors go into a relationship, and who cares at this point how old they are, but let's just say they fill out a questionnaire or a risk profile, and the risk profile says your advice needs to be in this lane. Okay. But by going in this lane and diversifying and having a portfolio that does X, they cannot solve their retirement need because it's so light on risk, because when they came in, their frame of mind, they just got laid off, bad news, they got a divorce, whatever. And they're like, I can't afford to take any risk, and all the advice that you have to give based on that risk profile is going to run them out of money. However, if you go to this lane based on what they need, and you say, okay, the risk is important, but if I'm going to plan, there's two ways. You can base risk on how somebody feels, or base risk on what somebody needs. So if you go on this needs analysis and you start designing the portfolio, not flying in the face of their risk or diversification, but planning according to a need, and you go down this lane, you can totally solve it. But now we have a risk problem. So I said, what do you do? What advice does your advisors have to give? Can they plan according to their need of what will solve the problem? Or do you have to go according to the sheet of paper that's basically like, okay, here's how I feel, and this is the advice. By the way,
it could change next week if they come in and they got the new job and they reconciled. And
I mean, how many times you woke up on the wrong side of the bed, and by lunch you're like you're living your dream. The first part of your day. Yesterday was that for me. Like, I got up, I was grumpy, I was having a bad day. I ended great. Yeah. But what do you do? And I'm asking, like, what advice are you mandating, or does your company mandate your advisors to give?
I bet it was door number one.
Because I'm asking the question this way, you're probably going, that one? Yeah. They have to give advice that will literally run the client out of money because it protects the firm. Because what they put down on paper is so important. It's almost like the bounded contract. It's like, no, this is how you feel. This is how you have to invest regardless of what you need. I'm like, are you kidding me? And he's like, yeah, it super frustrates me. And I'm like, why would you ever do that?
Right.
And he's like, because we have to. But I was so beside myself. And he goes, this is a very interesting dynamic. Nobody's ever asked me this question before.
Which is even more scary.
He's the head. This is the guy that's like, here's the advice you can give.
Thousands of advisors.
Thousands. Tens of thousands.
And no one's pushed back on this.
They don't even think about it. Their mind isn't, first of all, they're not figuring out what problem they're having to solve. They're figuring out what's appropriate. That is a bigger problem. And I'm just going to be direct, like, in our industry, like, it's so sad that firms they're out there to basically give advice that's in the moment, that's based on how you feel. That's why so many investors are disappointed. Like, that's why so many are frustrated going, well, all this guy wants to do is sell something. And you know what? You're not half wrong. Like they're not trying to solve anything.
Right.
They're using words like diversification and going, oh, we're putting your best foot forward. Are you? The industry, I mean, straight from the source of the top guy in charge of the type of advice you can give is like, well, we have to run them out of money. Now, they don't want to run you out of money.
Sure.
Like, this is a good guy. He's a Christian guy. He has a heart of gold. Like, he's awesome. But he is bound by the guidelines of that company on what he has to do, or what advice that his advisors are allowed to do based on that guideline. And it doesn't matter. And furthermore, they don't even know how to plan to figure out what's wrong. Like simplicity. Like the first step is like, what's really wrong? Like, what are we actually trying to do? Why would you hire me?
Yep.
And then once we figure that out, then we can figure out what they need. And then once we solve their need, then we can go back and go, is this acceptable risk? Is this, our portfolio diversified enough?
Talk
like
through this.
Yeah. Like you can have the one, really important thing.
Sure.
And then you can back up to, it's funny how we'll start talking about diversification and then it's like this huge picture of where it really fits. And you know what? That's investing. Like you can't just go, hey, I'm going to start here and then go here and go, hey, it's everything's going to work out right. You ever been frustrated before with your investments and in performance? You know why? It's because you're using words like diversification, sector allocation, risk, mitigation. You're like, hey, it's just not working. Yeah, you're right.
Because that's where you started.
Yeah.
Like that's usually one of the first things that you ever get handed at a normal, like at the average investment advisor firm. They're gonna be like, hey, if you could fill out some information about yourself and take this risk assessment.
Yeah.
And then that will inform how we then go and plan for you.
Yep.
Instead of the exact same way that you build a portfolio as an asset manager, you go build it and then we'll look back at it through risk and diversification. And like you should build the plan and then go back and look through it.
Absolutely.
Yeah.
So there are tons of sectors out there.
Yeah,
we're going to land this plane real quick.
Yeah.
You've got utilities, consumer staples, energy, financials, real estate, healthcare, technology, industrials, materials, to name all the big ones.
Yeah.
Okay. There's subsectors to those. Again, this is second fiddle. Like this, it's important. You don't have to go out there and go, in our portfolios, we have just about everything on this list, but we don't have to. Like, it's not like, hey, we don't have a real estate or we don't have we're always going to have utilities
and real estate,
or energy or financials, or healthcare. It's not like, hey, we don't have one right now. We have to put one in our portfolio. I would never say that.
Yep.
There are times where you can totally be over diversified in your portfolio and be totally fine. And there's times where you might need to be careful. There's so many things to talk about here. How I would say is this: if you really want to do a good job building a robust portfolio, I would, and I say this often, I feel like a broken record, but when I was growing up, I heard my parents many times say, show me your friends and I'll show you your future. So whoever you hang around with will determine, some part of your future. And I would apply that thought process to investing. If you show me your finances, I'll show you your future. So when you look into a stock, a company in energy and financials and utilities and technology, and I can look at their balance sheet, I can look at their debt, I can look at their finances. How are they spending their money? We can typically have a really good gauge on what their future looks like, regardless of sector diversification.
Right.
Like you could almost look at certain industries and look at their finances and go, yeah, like I'm not sure. Or even worse, look at an industry that's reeling, like just getting crushed, and go, why would I invest in that? Well, there's like 3 companies in there that are killing it. And when the tide turns around, the economy turns around, when certain things takes place, oh man, they're going to explode.
Yep.
Because you're looking at the balance sheet. Because I'll have investors all the time that aren't necessarily clients that are having their conversations with us, and they're like, why are we owning this? Like, what are you seeing? I'm like, have you looked at their balance sheet? Have you looked how they're spending money? You have any revelation as to why that stock has actually been depressed and got hurt from a stock performance? But man, they're bursting at the seams.
Yep.
And the sector is getting hurt and they're pulling down that price, but that company is growing leaps and bounds.
Yeah, there's recoil.
Oh man, I love that recoil to explode out. So yeah. All right. So How can we land this plane? What's some good advice we can leave the average investor
I
with?
think just piggybacking off of what you said, and even the story before that, is start with a plan. Be sure that you know what you're trying to solve for, where you're trying to go, especially for retirement. If you start there, find the solutions that help you with your need, not based on how you feel today. It's going to be a much better conversation. I think you'll start off in a better path, and then you can always look back and see if it matches up with how you're feeling or that risk side diversified. But start with a plan, solve for the plan, and then you can go from there.
I'd say that same thing, just different. There's two ways. I said this earlier. There's two ways to look at your future: how you feel or what you need. We are a needs-based planning firm. Like, how you feel is really important, like really important, but it's not what you need, or may not line up at a time of what you need. There's so many times in life where, as you've raised kids, you're like, wow, what he's saying or what she's saying is exactly what they need. And then there's those other times where you're like, what's coming out of their mouth is like completely contradicting to what you actually need to do.
Yep.
And that's life. Like, as a kid, as a teenager, as an adult, as a senior, we all go through those times of, we're misaligned.
Yep.
And you have to know what you need. That is the most important aspect of planning. Whether you're talking about sector allocation, diversification, risk profiling, knowing what you need is it's the foundation of every bit of planning. Then we can talk about how you feel. You can talk about how you feel before or after. It doesn't matter. You need to understand this. And you take this in consideration after you've figured out what you need and plan to solve it. Then you can have a very tough conversation or easy conversation, depending on how you feel, of how you want to move forward with that.
Yep.
So that's good stuff. Oh, and by the way, we haven't talked about this yet. If you haven't subscribed to our podcast yet, please do. Then you can get automatic updates to our shows. We're constantly putting out shows every single week, and it's been fun to do this. So hope you enjoyed yourself today, and until next time.
Hope you like the new studio.